Today, we're talking about the top 20 holdings of the best professional investors in the world. I'm going to tell you what those stocks are, and I'm going to tell you exactly how I even know what those stocks are and how you might be able to research them and follow them as well. But this channel is about transparency. I always talk about my own portfolio, what I'm doing, what stocks I own, so that you know if I own the stocks I talk about, if I don't, you know what my performance is, all that stuff. And the portfolio hit a high of $98,804 on August 12th. We have put in a total of $86,960. So when we were at $98,000, that was great. We were up $10,000 or $11,000. Well, now we've gone back in the negative. We are at $86,318. We started this on February 15th, 2022 with $10,000. And the goal is to build this up to $1 million in 10 years. Yesterday was pretty rough. We were down 2.9%, $2,500. On the week, down 12,000. So it's been a tough week, right? But on the month, we're still up 7,600. Okay. Here are the holdings that I own, just so you get a look at them. This is not a recommendation, just sharing the stocks that I own with you. Take a screenshot if you like. I talk about all of these on this channel, as well as in my email newsletter, austin.substack.com. All of this stuff for free. So go ahead, subscribe to the email newsletter if you want more detailed thoughts and analysis. This YouTube is where I can talk like high level. What you'll notice is that these stocks have not changed. I'm not trading in and out. I am building this portfolio over time. And in fact, now that these same great stocks that I liked a week ago are down 12, 15% with no news about their businesses, I am more interested in adding more shares. That's, in my opinion, how long-term investing works. The price action of the stock doesn't dictate me wanting to buy or sell. The value of the business and the performance of the business dictates whether or not I want to sell. And I do think about valuation as well. What are we talking about today? We're talking about the top 20 stocks of the top investment managers. Here are the stocks, and we're going to talk about each one and see if they're overvalued or undervalued right now. Adobe, Alphabet, Amazon, Apple, Coupa Software, DR Horton, Intuit, Lind, don't even know if I'm pronouncing that right, Mercado Libre, Meta, Microsoft, Qualcomm, C, ServiceNow, Shopify, Square, Trupanion, Tyler Technologies, and Visa. What we're looking at now is a site called Whale Wisdom that takes the 13F filings, the quarterly filings from these hedge funds, and aggregates all of that, puts it all together, and then figures out what are the most owned stocks. And the reason that this is interesting is because this is from 2017, but it's still real. It's probably even more now. Hedge funds are very secretive. In 2015, a $10 billion hedge fund revealed that its investment research budget was at $70 million. And, this site asks you, and obviously it's a sales pitch for Whale Wisdom here. I am not affiliated with them in any way. I pay for their service. How much did you spend in 2015 researching investments? And the idea there is that, as you're investing in the stock market, you're essentially investing against or alongside, these investment teams with nearly unlimited resources and budgets. And so how can we as investors, little us, how can we compete with them? Well, one way you could do that is essentially just by using their 13Fs and copying them. Some people have made this famous by just doing it with Warren Buffett. Every quarter when their 13Fs come out, just follow the stocks that they bought. And so that's the idea behind this. And this shows right here a chart of the performance if somebody had just copied Coatue performance. So the light green shows that since the first quarter of 2013, copying Coatue's 13F filings would have resulted in returns of over 85% over the same period. The S&P 500 return was 35%. Remember, this was back in 2017. If you look back 10 years, then using this back tester that they have, the top 10 positions 10 years ago, rebalance it quarterly as the new holdings were disclosed in their 13F quarterly filings. The clone fund would have resulted in a return of over 300%. That's 3x the return of the S&P 500. So what they're saying is that, a strategy of simply following some of these best funds could work, and it has outperformed in the past. And this is mimicking if somebody were to own an equal amount of each of these holdings and rebalance it quarterly as the updated filings come out. The annualized return back since 2006 has been 16% versus the S&P 500 of 9%. So you're getting a 7% outperformance there. Total return is a 1,094% since 2006, which is pretty great. 5-year return, still outperforming 104%. versus 84% for the S&P 500. 3 year, it's down a little bit, 32% to the S&P 500 of 48%. 1 year gotten crushed, down 45% versus the S&P down 6%. Year to date down 40% versus year to date S&P 500 down 12%, and 1 week down 9% versus 3.65. Okay, so something here. If these funds are making changes in between the quarter, you're not getting any of that information. This is not getting updated. And so therefore, the funds could have traded out of some of these stocks and avoided or hedged against them. A lot of times funds do that and avoided some of this downside, whereas somebody copying this is sitting there holding the bag and down 40% year to date. Okay, so again, I never recommend just blindly following anybody. Use things like this for ideas, but essentially do your own research. Let's jump over to fast graphs and see which of these stocks look undervalued right now and which look overvalued. We're not going to go too crazy with this. We're just looking to see if the black line, the share price, current share price, is over this blue line, which represents the average price to earnings ratio over the time period we're looking at. And we are going back to 2012, 2011. Okay. So Apple has a average price to earnings ratio of 16.7 over that time. It's currently traded at 28. Therefore, it's overvalued compared to its historical average. And with earnings expectation, it looks to continue to be overvalued into the future. Okay, Adobe, if you look at it on a price to earnings basis, it's trading at a blended PE of 32. Its average has been 39 over this time. It currently looks undervalued. Amazon, we can't use earnings just because it hasn't been profitable, but we can use operating cash flow. It actually looks pretty, if you look at the last 10 years, looks close to fairly valued in terms of what its average is traded at, but they're expecting some significant operating cash flow growth, which means it's currently looking undervalued if you're looking forward, 3 years, if they hit those growth expectations. Coupa's one, definitely more volatile. You've got to use price to sales. It looks significantly undervalued compared to its average price sales ratio of 17, but things got so wild after COVID. That's not a good thing to look at. Its blended price sales ratio right now is 6, and they're expected 14% and 20% sales growth. So I'd say Coupa looks fairly valued right now, knowing that it's a volatile stock. So I wouldn't say it's significantly undervalued just because this black line is below the orange line here. Things just got out of whack and pushed it way too high. So if you look back, price to sales was closer to 5, 6, 7, even 8 up to 9. I'd be more comfortable there than with a price sales ratio of 17. So Coupa looks fairly valued, maybe a little undervalued, but it all is just going to depend on if they continue to execute. And I don't know enough about the business to say what I think beyond just what the kind of fundamentals show. All right, DR Horton. DR Horton is a home builder that's and we know what's going on with the housing industry, and people are kind of panicking that there's a slowdown in housing and all this. So times like that can be great times to invest, but you got to know a lot about the industry. So again, this one takes some industry knowledge, but just looking at history, it's showing as undervalued. It's currently at a PE of 4. Its average has been 12 over the last 10 years. And they're expecting a drop in earnings for 2023, 5% earnings growth in 2024, which puts it at a pretty big discount to what it has historically traded at. Again, got to know about the industry with this one for sure, because housing is a cyclical industry. And there's Google. Even if we look at Google on a PE basis, it looks undervalued right now compared to growth expectations. Currently at a PE of about 22. It's traded around 24 or 25. If you go back to even pre-COVID, it was at 27, 23, 24. So this might be a good time to take a look at Google if you're interested in the company. It is showing as undervalued compared to its historical averages. Intuit's another one. If you look at the blended PE, it's at 37. The normalized PE over this time period has been about 32. It's showing as overvalued, and there's not a ton of upside if you're just looking for them to hit these expectations, if it's going to trade around its normal average PE ratio. And so Intuit's one that I think is a wonderful business model. It's a dividend payer, dividend grower, but it looks a little overvalued right now. Lindy, if I'm even saying that right, don't know anything about this company. Just by this chart and the fundamentals, it looks overvalued compared to its historical average, but they are expecting earnings growth of 11%, 10%, and 10% over the next 3 years. It's currently at a blended PE of 26 with a normalized PE ratio of 24 over this time period. Mercado Libre, this is one that I actually am looking at quite seriously right now to potentially add to my own portfolio. If you look at a price sales ratio, it's trading at almost the lowest price sales ratio it has ever traded at. There's a lot of risks with this business, but it's actually outperformed Amazon over the last 10 years. So it's very much a real business, right? There's just some risks because it's essentially e-commerce in Latin America, right? Which there's a lot going on there with inflation and all kinds of things that we're just not aware of in the US. So it takes some extra research to get comfortable with a stock like this. But showing a significantly undervalued. Its average price sales ratio has been 10 over this time period. Even back before COVID, it was around 10, down to 8, down to 7, and down to 6 and 5. That was in 2016 when things really sold off for them. So Mercado Libre might be worth a look if you're interested in e-commerce and some international diversification. Yeah, check out my newsletter. I'll probably be covering Melly in the newsletter, austin.substack.com. Meta, I've talked about Meta on the channel. Even if we look at it from a PE basis, currently at a blended price range of 14. Its average has been 39. I don't even expect it to get back to that. But it's so low that if it gets anywhere near, if this business essentially doesn't implode, you could have a winning investment on your hands over long term. With Microsoft is showing as overvalued. It's at a PE of 30. Its average has been 21 over the past 10 years. It's about as solid of a company as you can find. ServiceNow is one you got to look at. Price of sales, average price sales ratio has been 14. Back before COVID, it was around 11, 12. So I'd say 11 or 12 is a more realistic, price to sales ratio to look at. But they are expected to continue growing sales. And so ServiceNow is getting close to being undervalued or fairly valued. If we look at Qualcomm, showing as undervalued on a PE basis with a blended PE of 11.68. Its average has been 16 over this time. They are expected to grow earnings 47% in 2022. And then 4% and 4% for the next couple of years. So it currently looks undervalued compared to its historical average. It does pay a dividend of 2%, and they cover that dividend well. You can see right here, they cover that dividend really well. The green is the earnings of the company. The white is the dividend, and the payout ratio is 23% estimated, which is pretty low. And then C Group has been on a wild ride. If we look, there's really not enough data or history on this thing to get a good idea. I mean, it's currently at a blended price sales ratio of 2.8. It was back at 5 back in 2018, got up to 21 in 2021, and is now down to 2.8 with expected growth. The thing I can't wrap my mind around with this company is just scale and profitability, and they're in different businesses, and they don't have the proven track record of Mercado Libre, but maybe they're on their path to getting there. I personally would rather own Mercado Libre, especially since both stocks have sold off, than C, but that's just me. Shopify is another one that on a price sales basis is trading way down. It's at a price sales of 8, which it hasn't traded at since back in 2016. So it's either the buying opportunity of a lifetime for Shopify, or this business is not going to execute. It's not going to get profitable. They do have a pretty good track record of success back to 2015. They still are outperforming the market even after this drop. There's a lot of merchants on the platform, a lot of buyers. There's just so much weirdness figuring out what was just too much acceleration after COVID. What is e-commerce adoption going to look like? What is competition like? Are they going to get profitable? A lot of stuff like that, but it could be a great buying opportunity for Shopify as well if you're looking at it compared to its historical norm. Not this is not normal, but even back here at a price sales ratio, even at a price sales ratio around 8 or 9 going forward, if they continue to grow their sales, you could have a strong long-term outperformance here. Square, I actually haven't looked at Square in a long time. If we just use price sales, it's way below its averages. Its average has been 5.41. It's at 2.28. Wow. Block. So could be a good buying opportunity for Block as well. Again, we're not going to go back up to anything like this craziness, in my opinion. But you don't have to for this stock to win. Even if it trades around a 3 or a 4, if they continue to grow sales, you have a winning investment depending on share dilution. Trupanion. Trupanion, we're looking at price sales. I would imagine that's the right metric to look at just because I doubt they're profitable, but I'll take a look in a second. Price sales of 3.4. Its average has been 3.5. So stock has come down a lot, but it's trading right along its historical average. If that continues, then, stock looks overvalued or undervalued if you're looking 3 years out. Tyler Technologies, a blended PE of 53. Its average has been 55. Okay. So it looks about fairly valued right now. I have not spent a lot of time looking at this stock. Price sales is 9. Average has been 9, so right about in line. And then operating cash flow also in line. So Tyler Technologies, don't know a lot about the stock, but looks pretty in line with its averages. Visa, okay, blended PE 28.7. It's currently at 28.6, so right about in line with historical average. So if you like Visa, it looks fairly valued right now. If you look historically, it hasn't gotten super undervalued compared to its average very often, and so when it's been fairly valued in the past, it's been a good time to buy. That's it. All right, we're going to keep doing more of these videos. Let me know what you think. Do you want to know more about the stocks that these great professional investors own? Let me know in the comments.